Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today's Thursday. It's September 22nd. It's about 8:02 in the morning, and the market's going to open up in about an hour and 28 minutes to be exact with you. Again, you guys know the routine. If you're getting value out of these videos, if you have a question for me, comment, feedback, post in the YouTube WealthPress YouTube channel below this video, and become a member, become a subscriber. And if you have any questions, email me at support@marketgeeks.com. Now let's get started. So NASDAQ is down about 19 or 20. The Dow is up 13. This is the definition of randomness. Now, before we begin this analysis, we had the Fed increase yesterday. The Fed made statement. I'll get into all of that in just a minute. But typically, historically, in the last, I think, 3 or 4 times the Fed has done that, the market actually went lower right after the announcement, but then went higher for several days after. So I am actually expecting a rally, not just because of that, because the market's a little bit oversold right now as well, and I'll get into that as well. But for right now, we're just kind of not doing anything, flatlining. And we do have a report. We have the jobless claims report coming out in about 27 minutes, probably right by the time you get this video. This is a non-issue right now. The number is very, very low. It's consistent. The 4-week moving average is 224. The number before was 213. The jobless claims have been solid. That's actually been one of the things that have been very, very solid. Another major factor that I want to point out, interest rates. Bonds yesterday, and let me just kind of narrow this down. Bonds went higher yesterday, not lower on this announcement. That's a very, very positive sign. And if bonds typically move higher, that'll relieve pressure on consumer stocks and cause them to go higher as well. So I'm actually very pleased with what I saw yesterday, and I'm expecting the stock market to bounce back. Also, in light of all of that, just to give you an idea, look at the momentum levels on the number of stocks. And I'll get into the analysis in a bit. But I want to show you where we're at right now. This is 2008. This is where we're at right now. This is COVID right here. This is the last time Fed raised rates. We don't go or hang out these levels very much. And I'll talk a little bit more about this in a few minutes. Also, volatility did not rise yesterday with the market going down, and with this news, it actually went down. It did not go up. It did not rise. So I'm expecting volatility to come back to the 200-day moving average, and I'm expecting a bounce from these levels right here. A pretty hard bounce, actually. Let's talk a little bit about global economy. We've got a lot to talk about today. I mean, we do have a lot to talk about today. Global stock market sank Thursday, and remember, this is global, so we're a little bit ahead. This is why I do this report, because I'm trying to cover the blank page that you have between the time the market closes yesterday and the market opens. And this is what these videos are all about. I'm trying to kind of give you that bridge to give you a better understanding of where the market's going to be opening. So that's why it's important to go over global economy. I get emails all the time saying, Roger, why are you talking about Asia or China or global economy? It happened or already happened. Well, the U.S. market is being driven by what happened in Asia and China overnight and based on what's closing. So this is a really important piece of the puzzle to get you guys on track with why the market's doing what it's doing or why it's reacting the way it is right now. Federal Reserve delivered another big interest rate hike to cool galloping inflation and raised its outlook for more increases. And I'm expecting at least one more 0.75. The Wall Street benchmark fell 1.7% to a 2-month low, all while volatility did not rise. I'm just pointing that out. That's huge. That's very, very big. After Fed raised its key lending rate Wednesday, again by 0.75 to a 14-year high. We haven't had rates this high in 14 years, folks. It's kind of unreal, really. The Fed indicated it expects the rate to be a full percentage point higher by year's end than it did 3 months ago. So it is moving in the wrong direction. But we still have what? We're in September. We got October, November, December. We got 3 more months left. 1 more point. So I think they're going to do 0.75 and wait and see to how things go. The yen fell to 146 to the dollar after the Bank of Japan left its benchmark at minus 0.1. Big mistake. And its ultra-loose monetary policy unchanged. That underscores its divergence with the strategy of the Fed and other central banks, which has led investors to buy the dollar, which is why the dollar is so overinflated versus all the other assets in the world right now, because we've been buying it because we actually have an interest rate. Money's been moving into America. The Fed points to a relatively strong U.S. jobs market as evidence that the economy can tolerate higher borrowing costs. And that's very true. And the economy has been, jobless claims have been very, very steady. The employment is well. The yield on the 2-year, the difference between market price and the payout, over 4% now compared to 3.97. That's really high. That's really, really, really high right now. Mr. Federal Chair Jerome, wait till I get reappointed, Powell, to tell you the truth, stressed his resolve to lift rates high enough to drive inflation back towards the central bank's 2% goal. Yeah, in 3 years from now, right? Powell said the Fed has just started to get to that level with his most recent increases. Well, we'll see in the CPI next time around, right? The Fed released a forecast known as a dot plot that shows it expects its benchmark rate to be 4.4% by year end, a full point higher. That will happen, and that is priced into the market. Now, here's why. Consumer prices rose 8.3% in August. That was down from 9.1% peak, but, and here's what the Fed looks at, core inflation. It strips out the volatile food and energy prices and gives them a much clearer picture. It actually rose, up from July's 0.3 increase. So we're really looking at the core number. The core number is what the big factor is. That's what the Fed looks at. And it makes sense because food and energy is very, very volatile, especially right now. Central banks in Britain and Norway are due to report whether they will also raise rates again. Sweden, get this, they surprised economists this week with a full point hike. So it looks like the U.S. dollar is going to have some competition, at least from Sweden. The global economy has been roiled by Russia's invasion of Ukraine, which pushed up oil, wheat, and other commodities, and also natural gas, because natural gas is used to make a lot of these chemicals and so forth. So it's been a mess. Again, consumer discretionary stocks just dipped into that old window that we're trying to get out of. I think they're done. There's a huge correlation right now between the pressure on the bond market and the consumer discretionary sector, and the bond market rallied. And if the bond market can continue and get into this range, and let me just kind of continue drawing this line here. If we can go just a little bit higher and get into this range, that will release a lot of pressure from the tech and consumer discretionary heavy stocks. And if you look at momentum levels, we're just really, 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 really overdone. Now, I wanted to show you the momentum levels on individual sectors. Now, about a month ago, I warned you that the 50-day moving average is going to look a lot like the 200-day moving average, which it is. It's actually slightly below it for the most part. Some stocks like consumer discretionary are higher, but for the most part, I mean 14, 11, 19, 13, 16, 7, 14, 14. Real estate is just really, really, really overdone. Notice energy and utilities are still above the 50-day moving average, and they will stay there. Now, what's really great, and I pointed this out yesterday, is look at the number of stocks in the Russell, the small caps, trading above the 200-day moving average. And now look at that number in the NASDAQ. Look at that number in the Dow, 12, 17 versus 24. That's a bullish sign. Here's another bullish sign. The fact that Cathie Wood stocks, they did not break down, and consumer discretionary is still higher. So that's a very, very, very bullish sign. Now, today is Thursday, and typically on Thursdays, I give you guys my favorite sector. First, I want to look at volatility. Yeah, put the call ratio is still overinflated. Look at this thing. Let me just make it so you could see it. We're still above that level. So, folks, we still have a lot more. The market is overdone right now to the downside. The fact that we're staying near this area continuously is telling us we need a really strong buying opportunity, and I think we're going to get it either today or tomorrow. I think we're actually going to finish this week a lot better. Here's another reason why, and this is something I've been waiting to show you. Look at the number of stocks yesterday made 20-day breakdowns, 567. Look at the number of stocks made 20-day high, 20 versus 567. Do you guys remember about a month ago? About a month ago, when we were right up here, right in this area, the number of stocks making 20-day breakdowns a month ago. One second here. Let me just do it this way. Here we go. Look at this. Friday, August 12th. Look. 589. And let's look at a month ago. Here. That's what I wanted to show you. So look at what happened. Look at what happened right. That's the pro shares. Look at what happened right here at the edge, right when we were done with this thing. We started seeing the opposite. 589. This is the 16th of August. Let me show you a chart of 16th of August. Right here. Right here. When we made pay attention. This is really, really important. This is going to stand out. Look at this right here. On the 16th, when we made a high, we had 589 stocks making 20-day breakouts and 13 stocks making 20-day breakdowns. Now, let's go back there. We're here now, right? Watch. This is you're going to love this. Let's go to today. 567 stocks making 20-day breakdowns, 20 stocks making 20-day highs. So, when we were here, right in this area right here, you had, where are we? Sorry about that. Isn't this great? You had the opposite of this. You had here. You had somewhere around, oh God, so difficult. Sorry about that. Let's just go back a month. Why is this so hard? Let me go back 1 month. That's 19th. Let me go to 16th. 16th. Here we go. 16th. But the point is, you had, when we were breaking higher, when we were at the peak right here, you had about 500 stocks making 20-day breakouts and about 20 stocks making 20-day breakdowns. Now, today, you have 567 stocks making 20-day breakdowns and 20 stocks making 20-day breakouts. That's a reversal waiting to happen, folks. So it's time to start getting a little bit bullish right now. The market is going to reverse. Now, what sectors do I like right now? I'm going to be honest with you. I really like the consumer discretionary sector right now. I think that this sector is way, way overdone. I like the NASDAQ right now. So what I would do is I would be focused right now on one of two sectors. Either consumer discretionary, I think it's way, way overdone, or real estate. Now, I'm going to give you an option for both of them. All right, so here it is. Option for real estate, 38. I would go with something around, you can go something around right here, 43. Don't look at this price. The spread is way too wide, or you can go to 58 days left. You can go somewhere around here. You'll probably pay about $1.50, $1.60. And for consumer discretionary, I would go somewhere around December. You could probably find something here. You could do a spread. You could do the 153 versus the 157, or 153 versus the 160. Yeah, 153 versus 160 is great. All right, folks. So again, I think we're going to have a reversal. We're seeing the opposite of what we were seeing on the 16th of last month when we had 500-something stocks here and 20 stocks over here. 20-day high, 20-day low. And momentum levels look like market is overdone. Now, folks, lately I've been testing and trading a different type of stocks. Not the shares of Walmart, Apple's, or even Amazon's of the world. Instead, my attention has been focused on what I'm calling code breaker stocks. And once you see the type of returns we're delivering, you'll understand why. Today, 1 p.m. Eastern Time, I'm going live to show you exactly what they are and how to trade them. No, these are not speculative biotechs, risky penny stocks. They're not cryptos, but I'm going to spill the beans at 1 p.m. Eastern Time today. Bookmark the link below. Bookmark it. I'll reveal everything about these stocks, plus give you three top code breaker stocks straight from my hit list. This is brand new material, folks. I can't wait to share it with you. It's 1 p.m. Eastern today. Follow the link below. Check it out. Bye, guys. Take care. Have a great day.